We are delighted and honored to have President Raphael Bostic with us today. Dr. Raphael Bostic became the 15th president of the Federal Reserve Bank of Atlanta in June 2017. Before coming to the bank, Dr. Bostic was a professor of public policy at the University of Southern California in Los Angeles. He brings a wealth of experience from an outstanding career in academia, government, and research. Dr. Bostic served as the Assistant Secretary for Policy Development and Research at the Department of Housing and Urban Development. He's also spent several years as an economist at the Board of Governors. He has a passion for understanding the housing sector and how credit markets, financing, public policy all work together to help people achieve the American dream. Dr. Bostic has published extensively in academic journals. He's earned a PhD in economics from Stanford and his undergraduate degree from Harvard. Since joining the Atlanta Fed as president and CEO, he has spent much of his time in public outreach, sharing his deep knowledge of business and financial conditions. He's also a voting member this year for the Federal Open Markets Committee, the Fed's policymaking group. Please welcome Dr. Bostic. Our moderator for the event is Jackie Cushman. Jackie Cushman is a syndicated columnist, author, professional speaker, corporate strategist, corporate financial advisor, and board member. She authored 2 books that cover key points on our nation's history. Previously, she ran a financial planning department of $3 billion at a wireless company. Jackie has an MBA in finance from Georgia State and is a CFA designation holder. Jackie's nonprofit activities, among others, include serving on the advisory council for the Alliance Theater, founder and chairman of the board of the Learning Makes a Difference Foundation. She is a member of the Atlanta Press Club, the National Association of Corporate Directors, and the CFA Institute. And she's also on the board of the Atlanta Society's Foundation that works tirelessly on promoting financial literacy in the Atlanta community. Welcome, Jackie.
Thank you. Raphael, thank you for being here today. I'm particularly thrilled that you're here. I first saw you speak at the Atlanta Press Club, your first public appearance since becoming Fed president. And he was outstanding. You're really in for a treat today. He's incredible, very warm, very open, will answer any questions, so get your questions ready.
Not any questions.
Well, almost. I'll screen the ones that I think are not appropriate. So we will have I'm going to talk to Raphael for about 20 minutes, 25 minutes, and then we'll open the floor up for questions from the audience. Almost any question. But for me, I'm particularly excited because I grew up an hour west of here in a very small town called Carrollton, Georgia, off of I-20. And for me to be sitting here in Atlanta, talking to the president of the Fed is an incredible honor, so I'm thrilled to be here, and I know you are as well. So we're going to start a little more personally than professionally because people can read all professional stuff, right? But it's a little more interesting to get to know you as a person, and since I've seen you speak twice now, I feel like I'm getting to know you a little better, but would like to know more. So tell this audience, how your path here. Give us just a few minutes on how you ended up in Atlanta as the president of the Fed, and what maybe 2 or 3 key points in your career really made a difference.
Sure. So first, good afternoon, everyone. It's really good to be here, and thank you for the invitation. Really enjoy getting out and talking to folks and giving people a sense of sort of what we're thinking about in terms of policy, but also to get to know what you guys are worrying about and what kinds of things that you're interested in and want to know. So really happy to be here. In terms of my path, my path has kind of been a surprise to me as well. So I knew when I was in college that I liked urban places, I liked math, and I liked sciences. I had a crazy experience sort of my first year at Harvard in undergrad, so I got out of the sciences, chased into psychology, and then took economics as just something to do, and found out that I loved econ as well. So I just kept doing that stuff. My first job was at the board in Washington, Loved being in DC. Loved working at the Fed. The Fed was a great institution, and was really like an academic place. So even though we had a policy role, we were encouraged to figure out what the right thing was, what the best thing was, and go with that. I progressed pretty quickly. Got to a place where my next job was my boss's job. My boss wasn't going anywhere. He was 50 years old. So I was like, oh, let me look around and see what else is out there. And I was at a conference, and a guy, another professor at USC, said, yeah, we have this opening, you should apply for it. So I did, got the job, and wound up moving to SC as an assistant professor doing real estate forecasting. So I was a real estate forecaster as well as an assistant professor. Started doing research. My research was on Fannie and Freddie, a lot of the stuff around credit risk and portfolios and how housing markets were evolving. And then 2006, 2007 happens, right? And so all of a sudden, housing, which used to be a backwater in our field, became the thing everybody wanted to know about, and that was what I worked on. So I got a call from folks in Washington, would you come help try to deal with the housing crisis? I agreed to do that, was there for 3 years. Washington is a crazy place, but it was then too, so, but it was really eye-opening, and it's a tremendous experience, just to get a sense of how large the country is, how diverse the issues are, and how important good policy is to making a difference. But it's a place I couldn't be for a long time. So I got my 3 years in, feeling I was starting to get burned out and I had to get out of there. So I went back to USC, and when I went back to USC, I didn't go back as much as an economist, but as a governance person. Because one of the things that became clear to me was that a lot of times policies don't fail because we can't figure out what to do, but rather they fail because we can't do them. The institutions don't have the authority, they don't have the resources, they don't have the training, all that kind of stuff. And then I got a call, I'll apply to the Fed. Atlanta has this vacancy, let's see what happens. So I threw my name in the ring, never thinking that would ever happen. And then lo and behold, it happened. So it's been an interesting journey for me. I think that I've always made sure I was doing things that I really cared a lot about. And I've had some good mentors along the way that have really helped make sure I got connected to the right people, I was in the right meetings, I knew about opportunities and was able to take advantage of them.
That's an incredible story. I love the fact that it started with psychology, which is probably still pretty important in what you do in terms of understanding people's behavior, as well as the fact that real estate, now you're here in Atlanta, and obviously we're driven a lot by real estate. But talk a little bit about, has the initial interest in psychology influenced you in any way, or kind of made you think differently?
Yeah, so the psych stuff is really interesting because my undergrad degree was a combined psychology and economics, and most people think that's an odd combination. I actually think that they go perfectly well together. They're both really about how people make decisions. Econ is really the stylized, kind of clean models that assume everyone makes the right decision all the time. And then psychology really studies all the ways people mess up. Right? And people mess up a lot of different ways in terms of their decision. I should have put mess up in quotes, because sometimes the decision or rules that people come up with are really a function of the fact that the calculations can be incredibly complex, and it's hard to do them in your head. So you have to come up with other rules of thumb, but those rules of thumb systematically have biases. And those biases can either work to your advantage or your disadvantage depending on the environment that you're in. For me, it's really been helpful just to keep me of the mind that models are models, right? And we shouldn't expect the model to tell the whole story, and that there's more information that I need to get and that we all should be getting to try to understand sort of where the economy is going, why are people deciding the things that they do, and what kind of things can we do to anticipate where sentiment might go, or what kind of investments might be made.
So I love the fact that you talk about how you have the models, right, that are kind of the theory, and then you have reality, which the models can kind of give you an idea about but don't really interpret. As I mentioned earlier, I have a senior in high school who's taking economics, and for her, the theory is very attractive, but I think the hard part is figuring out where does human nature play into that, and especially tell us about how does that work in your current role.
So let me say just a couple things on this. So one, I'm really glad your daughter's doing this, right? So we need more women in economics and in financial fields. We need more minorities in economics and financial fields. So anyone who's doing it, I think we want to encourage that as much as possible. Second thing, at your next event, you're having someone who's talking about behavioral economics. A lot of this is about the psychology. Like, what are all the systematic ways that we mess up? And then how can we use that knowledge to prevent people from getting into bad situations, getting into bad places? And so I think this is really important for what you guys do, and it's also important for what we do. So we spend a lot of time going out into the field. I have a large staff that goes out. Actually, my staff probably says it's not large enough, but we have a staff that goes out into the field, and their job is to just drive around and talk to people. They talk to business people, they talk to community people, they talk to regular workers who are out in the field, and they do that to try to get a sense of what they see their challenges are, where they see their opportunities are, and to try to get a finger on the pulse of how people are feeling and what they're comfortable doing or not comfortable doing. And that's stuff that's intangible. It's stuff that's not always going to show up in aggregate data. The GDP number that just came out today is not going to tell us were people excited to be spending their money or doing it with a bit of trepidation. But it's those other things that provide the rich context that then allows us to say, okay, if they're nervous today, how much of the 100% that they may have done tomorrow will they do tomorrow? Or if they're excited today, how much will they do? And it gives us a sense of what sort of the upside or downside risk, that's the phrase that we use, on the economy is, which then can inform our policy decision.
So I'm going to switch a little bit and talk a little bit about back to your personal experience in getting here. So to put you in the spot a little bit, is there a single or is there one or two what you would consider then, but in retrospect probably not, failures or challenges that you've had to overcome along the way that you thought at the time maybe that I didn't get what I thought I wanted to do or something didn't work out for me, but in retrospect and looking back, you realize that you learned a lot from that experience and maybe has some applicability today here in Atlanta?
So I'll answer this in two ways. So one is personal, right? So, and it has to do with my aunt. So my aunt Pat, she drove me crazy because she had a lot of illnesses. So she had arthritis, she had high blood pressure, she had hypertension, she had gout, she had, you name it, she had it. But she wouldn't do the things to keep herself healthy. All right, so she had the salt shaker. It had the biggest holes I've ever seen in my life. She always ate. She wanted her shellfish and her crabs and all this kind of stuff. And for a decade, I argued with her. I yelled at her, "Stop doing this! What are you doing? You know, I take the salt away and put it away." And she never did. And after 10 years, I don't know what it was, but it hit me that she's a nurse. She knows all this stuff already. She just doesn't want to do it. And that was a failure on my part because I couldn't get her to do the things that I wanted her to do. But it also taught me that I got to worry about what I can control, and if I can't control it, I can't spend any energy on it. And it gave me a calmness and kind of a zen to be able to step back and say, okay, that's not my decision. It's not my control. I'm not going to spend any energy on it. So I think that's been very helpful for me and sort of giving me perspective, particularly as things get hard, that we control what we control. We got to do the best that we can about the things that we have a hand on, and then the other stuff you just got to be ready for. But you can't try to control those things. I can't spend energy on that. So that'd be one thing. Then a second thing that I would say is the assistant secretary job at HUD and the professorship at USC when I left the board. Both those jobs, I was the third choice. And don't ask how I know that, I just know that. And so I was the third choice, but the circumstance happened, I got in the role. And I could have gone in there with a chip on my shoulder. I could have gone in and said, okay, they don't really believe in me, so I'm gonna just be angry or whatever. And I didn't do that. What I tried to do was just take the job and be the best that I could in that job and make the most of it. And to me, that was a learning lesson. It took an adjustment to be able to say, okay, I'm going to step back, not let this be about me, let this be about the position, and keep my eyes on doing that. And that's been very, very, I think that served me well once I got that recognition. And here we are.
I think those are great stories, and I'm actually going to repeat those to my daughter, who's a senior, because those are ones that she'll need to learn. So you've moved to Atlanta. You've been in Washington. You grew up in the Northeast. You've been out to the West, and then you were picked for this position, and you moved to Atlanta. And I know it's not been quite a year, but I'd like to get kind of your thoughts about how that transition has been for you, and maybe what's the maybe the best and the worst surprise along the way.
So Atlanta was not on my list, right? So you had the list of places that I might move to. If you'd asked me a year ago, Atlanta was not on the list. So when this opportunity came up, and I got offered the job, I was like, all right, am I really going to do this? But then it's a great opportunity, and so it's not something that's easy to turn my back on. In terms of surprises, I would say I've been really surprised at how friendly people are. Right, so you hear a lot of stories about Southern hospitality, and I'd never lived in the South, so it was like, oh yeah, people are friendly everywhere. People here are really, really friendly, and it's made the transition much easier than I would have anticipated. I feel very comfortable. I've met lots of folks. People have been very helpful and giving advice, and it's been a really wonderful thing, and that's been great. On the bad side, so when I first came here, and this one is only half facetious, the roads are so narrow. I was afraid for the first month I was just going to hit cars and hit things all the time. And so that took some getting used to. But then the second thing, perhaps more serious, is that in this job, and I guess this is testament to this, people really pay attention to me. Like every minute. Like
It's a sold out room, right?
Every minute. And that was an adjustment. As a professor, I teach class, and you're up there, and you all know because you all have been in class, and any time there's a third of the class not paying any attention at all, right? And so you know that when you're in a room, you get to have a few throwaway lines. You can say things to amuse yourself because you got to keep yourself interested in the experience. But here, I can't do that anymore, right? So my first meeting at the bank, I was with some people, and I was in professor mode. I was talking. I had a few throwaway lines. The very first question was on the throwaway line, right? And I was like, "Did I say that?" And they were like, "Yes, you said." And everyone in the room said that. And I said, "Oh, I'm in a totally different place." And so it's really meant that I've had to be very present in the moment in a way that I hadn't been before, and very aware and sensitive about how my projection might be interpreted or taken by someone. And that's been, it means I'm on all the time. Yeah. And that takes a lot of energy, and it was really a reset that I've had to do, but it's been fun, and people here are nice, which has been helpful because there hasn't been a lot of extra drama that way.
That's great. Well, you can tell we're thrilled to have you here because we have a sold out room. And now we're going to switch. I love getting to know, you, the personality, and the behind the position. But obviously, you have a very important position as well, along with the fabulous personality. So let's talk a little bit about the position and kind of. I want to back up and say not just about the economic growth and interest rates, kind of the basic right questions. But before we get there, kind of take us through how you think, like your framework for thinking through. What things you look at, what do you think about, who do you talk to when trying to provide like an economic outlook of what's going to happen going forward? What's your thought process?
So we have a dual mandate. The first is maximize employment. The second is maintain stable prices. And so everything that we're trying to do, all of our effort is spent in the monetary policy space, just trying to get clues as to what's happening in the trajectory of prices and what's going to happen with employment. What that means is that we need to understand what kind of businesses, what kind of expenditures and investment businesses are going to make. We have to understand sort of where the consumer is in terms of their confidence about buying retail and more durable goods. We need to understand what the policy environment is and how incentives might be changing to drive capital to particular places. We need to understand where banks are and where the risks are in terms of bank portfolios. And we also need to know about international capital flows and where that's putting pressure on particular markets. I guess the short answer is that there's no shorthand, right? I mean, the market can be affected from many, many different places. I didn't even mention financial markets, but in many, many different places. And so we've got to be mindful about those many different opportunities for influence. And so I have a staff. I got maybe 30 economists on staff, and we try to span a lot of the field. And we meet on a regular basis where they're strongly encouraged to give us their best thinking about where the market currently is, some research, whatever research they're doing that gives us a different understanding about how markets work. And then we try to put it all together. Today, there's a big question about what's happening in labor markets. Right, so we've got an unemployment rate that's at 4.1%. That's pretty low by historic standards. But we're not seeing any upward pressure in wages, right? Which would suggest that maybe 4.1 isn't as low as it could possibly go. And so we're spending a lot of time trying to understand, is there slack in the labor market? Or have there been structural changes such as globalization and technology that have changed, or Amazon, that have changed the ability for prices to move? And whether there are some new dynamics. One of the things, I'll stop talking in a moment, but one thing that we've been doing, we have something that comes, we have advisory councils that come to the bank on a regular basis, and they come in various sectors. So there'll be a trade and transportation, there'll be an agriculture. We have one that is on human capital, and there's job search firms and temp companies. And one thing they said is that technology has changed such that it's easier for workers to apply for jobs. Right? And if that's true, then some of the labor market frictions that have historically existed are going away, which means that the unemployment rate should be lower at an equilibrium level. Well, those sorts of things we wouldn't find out if we weren't out trying to get the deeper information about how various parts of the marketplace work. And so we're always doing that to try to get that kind of knowledge.
So I know that one of your passions is in workforce development, and I know you're recently in New Orleans. So talk us a little bit about, because again, that also reflects back on the employment rate. So if we have, I know right now we're a little lower than we have, and historically in the 80s we were higher in terms of the labor participation rate. We're a little lower right now. But talk to us a little bit about kind of what you're doing and what your thoughts are around how do you get people that are not currently in the labor market back in the market.
Sure. So one of our missions is maximizing employment. The definition of maximum employment, that target number, is going to be a function of how many people are actually employable. Right? So we think a lot about, our staff worries a lot about, what are the barriers that are keeping people from having the skills that allow them to be employable so they can compete for jobs and be available when jobs open. So we know there are a number of sectors where there is a shortage of workers. You got nursing, you got trucking, you got a whole host of these things. And those are constraints in what maximum employment will look like for us. So we started an initiative, and this actually started before I got here, to start a conversation about, well, what are the skills that are needed in the marketplace? And make sure that everybody knows what those skills are, and we try to get out in front of as many people as possible to tell them. And then if you don't have those skills, what are the pathways that exist so you can get those skills? So we want to facilitate as many people as possible being able to develop a strategy that allows them to become employable. And this is particularly important in today's environment where we're seeing so much technological change. The introduction of technology, you got the Ubers, you have driverless cars, you have check yourself out at the grocery store. That means that there are a whole host of sectors where there are going to be workers that are looking for something to do. And so having these pathways becomes ever more important, and we want to make sure that even though we don't have the tools directly to affect those things, we're talking about them so that the folks that do have the tools and are in a decision-making role will step up and do that. So we're really interested in this. I'm very excited about the possibility. We were in New Orleans yesterday talking to a bunch of folks who at the city, and in New Orleans it's quite interesting because it's a public-private partnership, because I think appropriately so, the private sector is actually going to be hiring the people, right? So you want them to be in the conversation about, well, what are the skills that we need? where are the people that are going to come from, and how are we going to socialize that? But I think it's a conversation that needs to happen in just about all of our marketplaces, including this one. You mentioned the fact that there are a lot of people who aren't attached to the marketplace as much as possible. You know, Atlanta ranks, I think, 50th now in terms of economic mobility, which means if you're born into poverty, what's the likelihood that you will move out of it? Right? 50 out of the 50 when it comes to the top metros in the country. That's a function of, you know, our workforce development efforts, whether it be the schools or the community colleges or job training. Something's broken, right? And at some point that will become a constraint. If we don't have the workers that are needed, that's going to become a comparative disadvantage for the region, and something that I think we all need to be thoughtful about.
So talk a little bit, one of the things that we were talking about earlier on the table is, as you know, we have a ASFIP foundation that was started a few years ago by Steve Davenport, and really focusing on financial literacy. Obviously there's a lot of financial knowledge in this room. We're all professionals and we know the markets and how everything works, but part of our charge through the foundation is really working out, looking to the public and trying to educate them from a financial literacy standpoint, focusing at this point on college-age students, but also understanding that as we educate people, we really all improve it as a total society. So talk a little bit about your interest in that area, and then where do you think the efforts of the Atlanta Fed are to go in the next few years?
So this is one of my soapbox issues. For a long time, I've been advocating for more financial literacy present in our basic educational system, because this is something that everybody needs to be good at. Right? And if you make a mistake in terms of managing your finances early, that can have implications for years and years down the road, and it can prevent you from really positioning yourself to build wealth and develop assets and to start businesses and all those sorts of things. So I'm really very, very pleased that I didn't know about the foundation until today. I'm really pleased that you guys do this. It's really important, and any support that you guys give to help us all be more financially literate is quite important. I remember when I got my first credit card, and I was a freshman in college. I think you get them earlier now, I think. And my credit limit, I think, was $500. And I didn't make $500. I didn't have that kind of money, but I was cheap, so I wasn't going to spend the money. But I know others who did, and they got behind and got in trouble, and then their credit score gets hit, and then they have problems for the rest of their young life, and that's not good. So trying to make sure that people, when they're in the position of starting to be able to have some freedom to make their own financial decisions, have some resources that allow them to know what a good decision looks like as opposed to a bad decision is really important. We at the Fed, we have a large financial literacy program. We have some instructors that do this, and our strategy has been to teach the teachers and provide modules for high school teachers to give their students opportunities to learn more about financial literacy, so that by the time they get to you guys, they know a little bit and are more receptive to some of the issues. But this is something that's really important, and I don't think it can be overemphasized.
I agree. Okay, so this is my last question. So get ready with your questions out in the audience, because after this question, we're going to turn it over to y'all and see if we can get some good questions. So this year, you moved from a non-voting member to a voting member. And so just what are your thoughts around that transition, and how has it felt to you, and kind of your perspective on that?
Well, I actually thought it wasn't going to make a difference at all. You know, the way these meetings go, all the presidents and all the governors go to every meeting. We all have an opportunity to give our 2 cents on where the economy is and what policy should look like. So I was like, oh, just another meeting, I just have to vote at the end. But there is something different when they call your name in the roll call and you have to say something. And the first time there was a weight to it, which was pretty, it kind of surprised me a little bit, but it was pretty neat. Yeah, it's just been in some regards, this whole experience has been somewhat surreal, but it's been very exciting, and I'm really pleased to be part of the body.
I think that's actually a really great reflection on that. You don't really realize you have that weight, and then you feel it as you actually execute it.
No, it was something. Like,
Now you'll know going in next time. Okay, so at this time, we do have an extra mic, so if you would like to ask a question, if you'll raise your hand, we'll bring you a mic so we can all hear you.
Thank you. The executive branch has a lot of latitude to impose tariffs and then to remove tariffs. How does the Fed consider that policy in its deliberations?
So we try to figure out what the tariffs are likely to be, and then try to do some estimates as to the implications for the protected sector, and then the spillover to everybody else. You know, one of the challenges for us is really that first stage, and knowing what the tariff is likely to be. And if you look at the steel and aluminum trajectory, the first announcement was quite different than what happened at the end. And the scope and the scale wound up being quite different. And so, it is, for us, I think, I'm encouraging our staff to sort of wait until you're more certain about what the policy is going to be before spending a lot of time and spinning a lot of wheels trying to come up with estimates. Because it's, we have a finite number of resources, and there's, as I said earlier, there's a lot of stuff to look at. And I want to make sure that we deploy our resources in the most effective way.
Doctor, thanks for coming today. I appreciate you being here. The issue of volatility in the markets has become more prominent in the last few weeks. And I was curious as to how you feel the Fed's involvement with Powell or with Yellen has changed, or if you feel like there's a more of a freedom that they want to, the Fed wants to be less involved than they have been in the past.
So let me speak to the volatility, and I'll speak to the other stuff. In terms of volatility, you know, for thinking about the market, you think about the stock market, it had far less volatility in the last 18 months compared to what news would have suggested than we've seen in a long time. So if you have such a long period of sort of one direction with not a lot of the volatility around it, I think the VIX index was at historic lows, there was going to be a time where we were going to return back to average, right? And if you go low for so long, when it starts happening, it's not a surprise, at least not to me, that those initial periods would show a lot of extra volatility, sort of just balancing it out. So for me, I didn't read too much into the volatility. There was some irony that some of the biggest things happened around the weekend when the change happened. But I think that may be just correlation and not causation, in the sense that there were a lot of other things going on as well. What I would say about Chair Yellen and Chairman Powell, they worked together for a long time, right? So Jay is not new to the Fed or new to the board. He's just new to this chair. And I think that he's, as I think he said in his press conference, the gradual return to a more neutral stance is something that he was supportive of before. And I think unless we see data that suggests the economy is operating in a different way, I don't think there are going to be big changes there in his view. Now, I will say, for me personally, I think we need to get back to neutral, right? So unemployment is very close to something that equivalent to a full employment position, and inflation is approaching back to our 2% target. That if things are running at close to where we need them to be, or hope that they will be, then our policy doesn't need to be super accommodative. And we're in a more accommodative position now. So getting back to neutral, I think, is where we want to go. And in terms of a policy evolution, I think a gradual approach is more appropriate than trying to do just some big jumps that could trigger a lot of volatility that we wouldn't anticipate.
Right. And, you know, as business owners, I know a lot of people like to have the slow and steady, right? That way they know what's coming up and no big surprises. They
No
have enough big
surprises.
surprises in other areas. They don't need it from you, right?
Exactly. We want to be, just forget about the Fed. We're just going to keep going and do what we do.
Okay, other questions? I saw a hand earlier.
The Fed has reiterated its position that they are expecting inflation to rise. Doesn't that put a kind of burden of proof on the Fed that if it doesn't happen, it takes a rate increase that the markets currently largely expect off the table in June?
So it depends. What I would say is this, inflation is rising, right? So if you look at the 6-month core, it's the trajectory of that is up, right? So one of the challenges we have is if you go year over year, if you have one bad draw or 2 bad draws, that's going to pull the whole average down. Right? We know last March or April, there was like a 1.4 number in there that was driven by a war in telecommunications. They were pricing cell phone rates, right? So we're sensitive to the extent to which that aggregate year-over-year number is being unduly influenced by outliers. So we also look at it over different time horizons. I think over some of the shorter time horizons, you'll see that the inflation measures that we've been looking at are trending toward our 2%, right? So I think that the evidence is more there than some may understand, which to me says let's get back to neutral and let the economy play out the way it plays out.
So talk a little bit about what you've seen so far in this region about the challenges and opportunities that we have in a region. I know you come from a different area. We've been in California, you've been in the Northeast. Now that you're in the South and you've traveled around a good bit, kind of what is your view of our challenges and opportunities?
So our district, the 6th district of the Federal Reserve System, is 6 states. It's all of Florida, it's all of Georgia, it's all of Alabama, it's the eastern 2/3 of Tennessee, it's the southern half of Mississippi, and the southern half of Louisiana. And so that's a very large area. It's a very diverse set of economies, and it's 1/6 of the U.S. economy about, right? And if you look at the sectoral distribution, it's very similar to the U.S. economy's distribution across industrial sectors. So we're, in some regards, a microcosm of the entire country. In terms of opportunities, I think that there's a lot of tech that's emerging. There's a lot of innovation that's happening. I was at Georgia Tech the other day. They're doing a tremendous amount of building of state-of-the-art science facilities. If I go to mid-tier cities like Birmingham or Knoxville, there's a lot of energy around the colleges and universities there and doing research. Miami is having a boom again with the international capital and a lot of the tourism and trade that's kind of reestablishing itself. So there's a lot going on that is positive and a lot of growth. But at the same time, there are multiple economies in the U.S. And there are multiple realities. So I take the state of Georgia as an example. Right? So if you look at Georgia and you ask where are the jobs being created, out of the 159 counties that are in Georgia, it's maybe in 15 of them, right? Which means that we got about 145 counties in the state where there's not that kind of vibrant energy and that vibrant activity. And so we're going to care about that. I think we all should care about that. For me, I want to understand that better. And so we're actually going to start going to some more rural places to get a sense of what they see as their challenge and barriers are to being more connected to the broader economy, and to see if we might be able to find some solutions to that. Because one thing that I think that we see, for example, when we talk about trade, is that very many people have serious fears that the economy is leaving them behind, that the changes that are happening in a way that they don't see a future for themselves, and that's not good for the country, because it could cause a lot of people to check out, and then that feeds back to our notion of maximum employment. That gets right back to sort of where we are. So I want to make sure we understand what's going on at a very deep way in these places so that we can start to identify the partnerships and the connections that need to be made to develop new strategies that can get them reconnected or better connected so that we can get to more growth.
I love the way you focus on not only connecting, but also people have to have hope. In the end, they have to have a reason, right, to either work hard for education or to try to get new skills and training, but they have to understand that there's a place for them in the economy where they can be productive.
Yeah, and I worry that we don't tell people that enough, right? We talk a lot about all the problems, all the challenges, all this change and disruption, and we never finish the conversation to say, yeah, but change is happening in this country all the time, from its very earliest moments. We all used to be farmers. We're all not farmers anymore, and we're okay, right? So let's not fear change. Let's understand it. Let's understand where there are opportunities for tomorrow, so that we can develop strategies and get to a better place.
Perfect. Any more in the back? Have some questions?
Thank you so much for being here. Can you talk a little bit more about change in terms of the way the structure of the economy has changed, but the ways we measure it may not have changed as much in terms of GDP? And how should we think about that when we look at GDP-related measures like productivity, where GDP may not be capturing all of the economic activity that's influenced by that?
Yeah, so this is something I definitely worry about, and I don't think I have all the answers, so I want to start by saying that. The world is changing, right? So I left my cell phone on my table there, but we all have a cell phone, right? It allows us to do things faster with a broader set of people. We all take pictures now. We don't need an extra camera. We don't need all those sorts of things. So our productivity moment to moment has changed, right? I'm not sure that fully shows up in terms of our measures. What I'd say is this is a problem that has existed for a while, right? They weren't doing national statistics in farmer days, but they would have had this challenge then as well. The episode I'm most familiar with is in the mid-90s, when we were starting to introduce PCs completely through into companies. And for 6 or 7 years, we were like, well, where's the productivity? Where's the productivity? We know we're being more productive, we just can't find it. It took researchers a good 7, 8 years to really figure out how to measure that. And then they redid everything, and it turned out we were a whole lot more productive. That may be happening today, and so we are asking all of our strongest minds really to think about this, and how should we, how might we be missing this? And we haven't found obvious answers to this, but it's something that we're definitely going to work on. But I think, and this is just to be fully clear, this is a really important question, because if you think about what potential output is, worker productivity is a huge component of that. And so if we're mismeasuring it, we may be understating how fast the economy can grow. And so it's something that we're definitely working on. And there are academic economists that are working on this as well, that we are deeply in contact with.
Thank you, Dr. Bostic. Thanks for taking my question. So we're now in an environment of rising interest rates, and if you look back 100 years and you study some of the episodes of financial crisis and recession, whether it be the Great Depression or the 70s, 87 stock market crash, or even to some extent the internet bubble, they all occurred in periods of rising interest rates. So I was just wondering how that makes you feel, if that's something of concern, and if so, what are the leading indicators that the Atlanta Fed looks at to determine whether or not we might be, close to triggering again, a recession as a result of rising interest rates? And maybe in that context, is the performance of the stock market one of those indicators that you would look at, or is it primarily, inflation and employment numbers? Thank you.
So, thank you for your question. I would say, yeah, we worry about that, right? So, So on my watch, I don't want to be the one that they point to and say, oh, he's the one who caused the recession, right? So I don't want to do that. That said, it's not every moment that we increase rates that the economy flips into recession. There's a calibration that takes place, and we've got to do that calibration on a daily basis. I would say, our frontline measures are mandate measures: unemployment, inflation, GDP growth. Those are the things that are a measure of where the real economy is and how it's performing. Financial markets, though, we do know affect the allocation of capital and the allocation of resources and what kind of investments that get made. So we definitely think about that and keep an eye on that. I wouldn't make a sole determination based on valuation in the S&P or the Dow, because sometimes there is some emotion that happens in the market, and I don't want our policy to be driven solely or overly by that. But yeah, we think about this a lot, and I would say you've heard many of my colleagues across the country, assuming if you're Fed watchers, there's a diversity of views on how far we should go before we're in that danger zone of being a trigger for a contraction. I don't think we're there right now. I don't think that the data suggests that we're there now, but it's definitely a concern that we are working and managing.
So unfortunately, our time is almost up, so we have time for one more question, please.
By extension of that last question, given your background on housing, are there any parallels that you're seeing today in your district, here in this part of the country, relative to a decade ago? We're obviously seeing a reasonable rise in house prices.
So are we on the cusp of another housing crisis, I think is your question? Well, we did such a good job predicting the last one. No, seriously, I think right now we are in a position where there are a couple things that are different compared to 10 years ago. One is that the credit quality of the average borrower is much stronger. A second is that the preponderance of alternative mortgage instruments is much lower, so the amount of leverage that's in housing markets is quite different. Those give me some comfort. And I would say we're also, the regulatory agencies are much more aggressively monitoring banking institutions and the allocation of capital. So in the last crisis, the 6th district took a severe hit in terms of banking institutions. We had more foreclosures than any other district. We had more bank failures than any other district. And so it's something that our staff is extremely concerned about, and we watch it very carefully because our guys are like, that's not happening again. And I will tell you, every banker that I talk to, I tell them exactly that. This is not going to happen again. And so we are much more engaged, I think, in that regard. And that gives me some comfort that the wild swing that that happened the last time is far less likely to happen today. That said, their pressures are real, right? So you guys know cap rates for many of the deals that are happening in hot markets are getting extremely low. Valuations are going to levels where questions should be raised about whether there are enough families or enough businesses that have the cash flow to be able to cover the payments that are required. And I'm hopeful that due diligence will carry the day, given our recent history, and that we won't see such widespread running into deals where you have to make historic assumptions and heroic beliefs about where rents can go or what incomes are going to look like, because there was a lot of that happened in the last episode, and we don't want that to happen again.
That was the last question, right?
Yeah, that was the last question, yeah.
Thank you, Dr. Bostic, for coming and sharing your views with us today on diverse topics from financial literacy, women in economics, to the economy, interest rates, and of course, your personal life. Truly appreciate it, and I've truly enjoyed it. So thank you so much for being a guest for the Atlanta Society.
Thank you. It's very good to be here.
And thank you, Jackie, for moderating the session.
Absolutely.
Thank
We
you.
had a good time. That was fun.
It was great. Thank you again. I really enjoyed it.
Thank you, everyone, for coming. I hope all of you had a really good time, and we hope to see you at our future events.